and get yourself to a point where you can rely on that income in the same way as you can rely on your salary or the income that you draw from your business. That's the objective. Now, when I do the seminar at the banks, and I've done it for all the local banks here, and I've done it for most of the banks in London, it takes 3 days, and I'm going to try and do it in the next 40 minutes. Okay? I've got a lot of slides, and I probably won't get through all of the slides, but I'm sure that the guys at Fund Board will send you the presentation if you wish. Okay? My association with the company is that the founder, we'll see, I don't know where he is, but the founder of Visi and I have been doing business together since he was 30 minutes old. And it doesn't seem that long since he was shouting at me when I was actually going to my office in Livonia. He used to shout at me and said, "Kit Kat," because he wanted me to bring a Kit Kat home that evening. So any of the Fund Board people listening, if you want to bribe the boss, just buy him a Kit Kat. The thing that stood me in best stead in markets is that in my youth I was an officer in the Royal Marines. And that's given me a level of confidence and discipline that I've drawn upon for a very long time. And 42 years later, I can still fit into a uniform. As anybody who feels like having a go can have a go. I've only got one regret in life, and that one regret is that if I was 35 years younger, I'd be a professional rugby player today. Because I came to South Africa to play rugby. That's why I came here in the first place. And got an injury from it. But I think if I was 35 years younger, I'd be a professional rugby player. So I'm not that good with contraptions, so I'll do my best to make the slides work. Yes, so I talked about an age. I'm going to try and talk about an age. My age is very similar to what these gentlemen just presented. I like to put the fundamentals and the technicals together in the stock market. My definition of fundamental analysis is the search for the true value of a share. My definition of technical analysis is the study of trends and turning points. And ladies and gentlemen, I want to try and find a share that's undervalued, a share that's growing its earnings aggressively, reasonably safely, that's rising, that's in the throes of a strong trend. And ladies and gentlemen, I want to buy that when the general market is rising. Okay? And that's what I've been doing for a very long time. I do my best to stick to that. Those of you that have been trading for a while will know that sticking to a simple set of trading rules is an awful lot easier to talk about than to do. Am I correct? Yeah. Okay? And as if there's little devils on your shoulder shouting at you to do the wrong thing. So, to make some money in markets, folks, we need some form of a method. Yes? We need to manage our money really well. We need to manage ourselves really well. The 3 M's. So, I'm going to talk about a methodology. So, I'm going to ask you a question. Did they put that chart in? There we go. There's the Aussie 40, I think I asked them to put in. And my question to you, that's a MACD. I know the guy who put the MACD together, a good friend of mine, a guy called Jerry Appel, and he said that when he designed the MACD, an axiom of investment education is the more complicated it sounds, the more you can sell it for. And he thought that MACD was suitably complicated. That's why it's called the moving average, converging, diverging. Jerry Appel has 2 sons with more money under management than the Nasdaq, just the 3 of them. A little room in a place called Dairy Lane. Stephen King reads his books just across the room. Is the JSE going to go up or down on Monday? My question to you. What do you think? Down? Young man says down. Any other? Bradley, what do you think? You're the expert. Up? Well, folks, in my pocket, I have the secret. Let me find it. I have the secret. It's a 5-round coin. Now, on one side, there's a very little animal. You see that? On the other side, you've got a coat of arms. Clearly, the coat of arms is going up, and the very little animal is going down. Let's see if I can get it right.
We'll pause there and I'll just kind of ad lib on what he's doing. He started set up and show you guys probability. So kind of pay attention to this scenario he's going over. He asked him, was the chart going up or down? He got all these different participants, like who really knows? So he pulls out a coin and he's gonna leave it to a head toss, but he starts breaking down probability.
Right, the head, it's going up. Okay. Would you trade like that? No, okay. But I assure you, most of you are trading like that already. There's a great deal of randomness out there, I assure you. But I wouldn't like to trade like that either. So, my next question to you. Let's play and think about a special game. So, here's the game. If you can successfully predict heads or tails, and you're correct, if you bet 5 rand and you're correct, I'll give you 10 back. Clearly, if you're incorrect in your prognosis, I'm going to take 5. Now, you've already said that you wouldn't trade with the coin, but would you play that game? Ladies and gentlemen, that's my question to you. Would you play that game? Yes or no? Well, folks, I haven't a lot of time to play this, so it's a cracking game to play. And it's the basis of how you can become consistent and take money from somebody else, because that's what you're doing. Because in 10 chunks of the coin, would you agree that you should be right 50% of the time? Yeah? Now, when you're right, I'm going to pay you twice as much as when you're wrong. So in 10 throws of the coin, when you're right, I'm going to pay you 5 times 2, which is 10. Yes? And when you're wrong, I'm going to remove 5 times 1, which is 5. Thus, you make 10, you make 5 profit. If you bet a rand on every time you chuck the coin in the air, on average, you're going to make 50 cents. You have now designed a positive expectancy system. So if you can find somebody to underwrite that, then marry at your age. Okay. And that is the objective, folks. Now, with the FinPort guys, with GT, you should be able to get your hit rate above 50%. But if you can be right 50% of the time, and you can make twice as much when you're right as you lose when you're wrong, then you've got a method of making money for the rest of your days. And that is the challenge.
All right, I'll jump in here. But he hits on keywords, edge. It's always been deeper of the conversation, so that's why I spend a lot of time kind of speaking mindset with you guys and different tactics is outside of the chart. He's speaking on edge. He kind of threw us for a loop there because he said I wouldn't want to play that game either, but then he goes to explain how he's actually playing that same game, but with a skewed expectancy. So you guys always know I'm heavy on risk to reward.
To learn how to play the game over and over and over again without fear or hesitation. Okay, so it's a cracking game to play. Would you play the game? Now, in trading, the number of times that you're right is called the hit rate. And Lord only knows we're all paranoid about the hit rate. We want to be right at all costs. There are 4 trading fears. 1 is being wrong, 2 is losing money, 3 is missing out, and 4 is leaving money on the table. Those of you that are under 50 are probably in a safe place because I know for a fact that most men over 50 are more scared of being wrong and losing money than they are of death. Okay? Am I correct? We've got the death thing all sorted out. Well, it's not the end of the world, okay? But to be wrong or lose money is an issue. So, the other thing that's important in trading is the risk to reward ratio. So the money that you make is a function of both the hit rate and the risk to reward, and most of us just think about the hit rate. So 3 things. Now, if you do a search on the internet, and that's a margin call, don't take it, okay? Don't take it. Just ignore it completely. The margin call is what happens, folks, when you run out of wood. And lads from GT are going to phone you here and say, more money, or we close the whole bloody margin, okay? So if you get a call, just don't take it. If you do a search on the internet, you're going to find lots and lots of systems where the vendor says that you're right 92% of the time. And they all sound wonderful. But the problem with those systems is that they've got to open up their stop losses so wide in relation to their targets that they don't make any money. And this was brought home to me a few weeks ago. And this is a chap in London. He was advertising a Forex system. Somebody spoke about Forex, and he said he's right 90% of the time. Sounds wonderful, doesn't it? But when he was writing his own literature, he said this. When he was right, he makes 10 ticks. And when he's wrong, he loses 90. What's the expectancy of that system? 9 times 10 when he's right, minus 1 times 90 when he's wrong, and that means the system actually loses money. Sounds wonderful 90% of the time, but he loses money. So folks, just remember that edge is a mixture of 3 things. It's a mixture of the hit rate, it's a mixture of the risk to reward, and the commissions. And there's no doubt that if you're trying to scalp a 1-minute chart, you need to be really, really good, because those commissions mount up. Every time you press the wee button, there's 3 or 4 ticks to be paid. And that's hit rate, risk reward, and commissions.
All right. So I think that's kind of mainly, could have go a couple more minutes, but I'll let you guys watch that on your own. But here's some key facts that you guys may be getting tired of hearing me say. Especially the point about someone having a 90% win rate and still not making money. That's one big thing that kind of blew my mind when I first, heard it and started to experience it. Like that, it was just backwards for me. He also hits on the 3 factors that makes an edge: hit rate, money management, and risk versus reward. These are what really makes a winning trader. Like I told you guys, I think the other day, that they used to trade with ticker charts, or they didn't even have charts, but they still would make money because it's deeper principles than, the fanciest indicator suite, system, chart setup. What really makes a winning trader is those principles he talked about. It all comes from inside. Also, what that setting up or building your system in that manner of following those 3 principles is going to allow you to remove a lot of emotions. It's going to remove you out of the equation a lot. So, I'm to the point now where I'm getting where people, like, we had a gentleman in the chat earlier, like, oh, this is in drawdown, or, I'm a buyer, why are you selling? Like, I can even see sometimes that the trade is going, it looks like it's going to be a buy, but if my system, the things that I'm looking for tells me to sell it, I'm just going to sell it because it's almost mechanical for me now. If it's a loss, it's just a loss, but I know my expectation is so skewed that if I keep taking the trades, eventually 1 of them, 3 of them is going to run to how I need them to run, and it's going to pay me back for all the headache of seeing my stops get hit. So he covers that. Most traders are around like 50 to 60%, and these are billion-dollar traders. And even those guys have an issue with, it's going to be a forever issue with being wrong. I don't want to be wrong. I don't want it to hit my stop, this and that. And that's one of the key skills that you learn as you progress as a trader. He made the comparison of somebody just trading 40%, which is still going to be a heavy, huge hedge fund, maybe top tier investor, is probably going to be in better shoes than someone trading a 50%, because that person that's 40%, if he knows what he's doing, he knows that his edge is going to play out over the long run. He has a skew, he may have a skewed hit rate, but he knows based on what he's trying to do, that guy that's running like a 40%, he's probably looking for a 1 to 10 risk to reward, 1 to 7. So he knows just one of those trades is going to give him 7 times of what he would lose on the other 60% of the time. So we click in the math. 40% of the time he's going to be getting back 7x, 10x. 60% of the time he may be losing 1x. He's going to be losing 1x when it's all factored in. So we do quick math. He's going to be in the plus somewhere around, let's see, 400, 200 plus somehow somewhere or around when you factor in the losses. So he's usually a lot less nervous. But we'll look at the little charts. I like the way he broke that down. Did anybody like the style that he was speaking, or did any of that speak to you?
Yeah, it reminded me of trading in the zone actually. Like it takes you out of the mentality of like thinking like a gambler and thinking more like the house, like the casino. That's what he was talking about in the book. And like the casino always have their edge. So like, a player can go and have a good day in there, but at the end of the day, the casinos still have their edge. They still have their game that they play, and they still become profitable at the end of the day.
Yeah. It's all about your edge, bro. Developing your edge. So I've been working with a few of our classmates and just getting them to try to get me data. They may have to, even if it's demo or whatever strategy they want to use. I don't care if it's when you see 2 wicks, you sell. You know what I mean? Like we can build anything, and I can't say we can make any strategy profitable, but we can build upon it and start giving the understanding of, okay, this is what I'm looking for. I know, we can see if it works or if it don't. So whether it's just every time I see an EMA cross, I follow that strict rules. We document it. We see did you have a correct expectancy? Were you expecting, so many pips for risking so many pips? Did you just get out? And then we look up a few hours later and the trade went in your direction. Did you, hit your expectancy and you just held the trade? These are things that's outside of the charts that most don't want to speak about, but it comes to a certain point where it stares you in your face. It's only so long that you can run that strategy without knowing the other elements of it. I even go as far as to say I didn't see people make a few $1,000 just, either taking signals or doing something quick that they've seen on the internet, and it excites them. It plays with their emotions. They think this is how it's going to happen, and then they end up eventually giving it all back or blowing the accounts, and then you just stay in that vicious cycle. So that's what I'm trying to help everybody avoid. Even when we go deeper into deeper perspectives and things that's going to even help your edge, like diving into this volume, diving into, psychological level, quarter points, bankers open, bankers close, order books, switching of the books, everything, futures data, COT. These are just tools we're going to be using to kind of help us improve upon our edge. But if we don't have these key ground things together, all that's going to be just a waste of time. You're going to start getting lost. You need to know the core elements in order to perform with this information, these different things that we're doing. So, I think it was kind of vital we we dove into that because I get a lot of activity. I get a lot of people show up when we speak on when I dive into technicals, show technicals. Everybody think that's where the sauce is, but it's not. It's really all itself. So trying to avoid y'all from years. Like I spent a few years just studying chart work, and then when I got it, when I pulled away from the charts, it's like it just started clicking. Within a few months, I was profitable. I was flipping accounts. I was, so I hope it helped y'all, man.
I feel like that's where I'm at right now. It's like I've been trading about close to 3 years now, and yeah, I was that technical guy looking for the next technical shiny object to help me win, and it seemed like it was much deeper than that. So that's why I always wanted to add like fundamentals to the game. It helps you shoot your shots with confidence. Like when you bring those different elements into your trading style, it's opposed to just basing it off technicals.
No doubt. I'm gonna send you this little article about the dimensions of trading, but you get another perspective. Each one of these elements is gonna be a different perspective. So you marry, the technicals with the fundamentals. And I would even still go as far as to say this outside of the chart work, like risk to reward, things like that, is even more important than fundamentals or technicals. We may all hear the saying, well, I don't know what they say, but I always kind of ad lib it. I say trading is 80% psychological or mental, 10% technicals, 10% fundamentals. So it's heavily skewed towards, okay, yeah, you got in a trade, but what are you gonna do when you're in it? How do you react when you're in it? Or are you letting them ride? Are you, a lot of people don't like to face that part of the game because it's really you versus you at that point. Like you start noticing, like, damn, I'm real anxious, an anxious person. Why do I want to be so fast? Like I see that I need to chill out. Or you'll be like, man, why do I get so timid or so fearful when this is going against me? Or why do I get so excited when it drops in my level? Because I done had times myself where I start seeing big red candles and I'm like, man, let me just take this money. But if I will look at the amount of pips, it may have only moved like 40 pips. And then it keeps going for like 160. It goes crazy. And I'm like, man, I should have just stayed in the trade. Or vice versa. I'm in a losing trade. It's just going against me. It's going against me. I'm steady trying to short it. Within due reasoning. There's different reasons why you would do that, but I'm steady. I'm fighting the trend. So those are the elements that's gonna, keep you on the right side of trade and kind of out of harm's way. Let's see what I got here, though. We'll look at something real quick. Let's take a look at the dollar, man. Dollar's been funny. With all this news, I think it's finally breaking down. Now, when Eric E, I heard you speak about fundamentals. So one thing is trying to stay from bias, from having or building a one-sidedness. Like even with me, I'm sitting here, I'm looking for USD to go bullish. So when you start diving into looking at fundamentals, you're gonna find fundamentals that match your view. What I would say is always to kind of snap you out of that is just come back to the chart and see what the chart's doing. That doesn't mean that, they may not be testing, shaking out buyers, but the more it comes down, the more I'm not gonna just close a trade, but I wanna negate my risk. So if I'm in with a 0.5, I may take off a 0.2 and let it roll on my stop loss. If I'm trading like AU or something, it's still got a heavy candle coming in. Looks like it's just pushing down. I really don't see this continuing, but I don't want to paint my own view on the market because the market can do whatever it wants to do. All it takes for Trump to come in here and say, hey, we just signed a deal, off she'll go. Or for Trump to come in here and Pelosi say, we're not going to sign a deal. Whoop, there you go. You know, break through all type of resistance supports. So I don't want to marry a bias, but I do want to give it time to work. So if I find myself in a losing position, I'm like, hey, I don't know what it's doing, is acting weird. I may not close the whole trade, but I'm gonna take off a partial. Take off a 0.1, take off a 0.2. Let it keep rolling. When you're in drawdown, the goal is to get small and the trade small until you start working your way out of drawdown. Most people do the opposite and they increase the lot sizes trying to get it all back. You more want to start snipping out, go smaller and smaller and smaller. We don't just, the goal is not to just close a trade, but to negate risk or to minus the risk, not just cut it all the way off. Because you could cut off that winner. Like even if I was in at a 0.5 up here, the market did this. So when I got about here, I set it to a 0.2. Who's to say that 0.2, I may have just been expecting that 0.5 to go up to here because I knew it was a heavier lot. But when I cut it short, who's to say it doesn't blast off and that 0.2 goes up here, pays me back for the little bit that I took off and was a winning trade.
I get what you're saying.
So you kind of negate or start making it smaller, your risk smaller more than just saying getting frustrated and cutting the trade off. That was it.
Yeah, I didn't think about that. And then
I was gonna say I never thought about it either. Don't mean to interrupt you, but I always would just be like, "Give club, but go shoot away."
Oh no, yeah. I didn't think about like negating the risks like that, and then definitely going back to the fundamentals. I definitely picked up on that early. Like I don't want to be like, headstrong. Like, oh yeah, I know that fundamentally like what's going on in the world now. I know that like gold is supposed to shoot up, but like obviously, markets have to correct and consolidate, and the market does what they got to do, and I just can't see a mirage all the time.
No doubt, yeah, you can't mirror that. Then take it as the effect that market conditions change from moment to moment, day to day. Fundamentals are longer term perspectives. They can kind of let you see over the hills, but at the same time, something could have just happened. We could have went to war in Timbuktu. That you were right with your fundamental view and probably your technical view, but the market condition has changed, are built up and changed during this specific period in time.
Yeah, and see, like, I want to get off of that, like, autopilot perspective. I still want to, like, critically think.
No doubt. It should help you, man.
Oh, yeah, it's good nuggets tonight, man.
Oh, good stuff, man. I will just say, man, that will, like you said, just keeping critical thinking skills will help with your analysis. Once you go to your analysis, you go back to mechanical. That's just letting whatever rule base you have or systems, letting it do the work. So you see the setup. You may have some critical thinking skills as far as like putting together a picture with mixing fundamentals and technicals. But then from there, you no longer. One of my old mentors used to say, you no longer a trader. You don't have a hat on as a trader. From there, you're a money manager. Your job is just to negate risk, let it run, either add risk. You just manage your money from there. You're no longer a trader.
I get that.
Yeah, bro, man, we're gonna cover. I guess I feel like what you think, man. I feel like it was a good session, man. They missed out on one.
Oh yeah, man. This was good. This definitely was good because, like you said, people always go over the technicals and like they never really get into like what traders have the problem with the most, and like it is like psychology and like risk management.
I agree, man. I'm over trying to eat a Snicker, man, but when I talk to traders, it'd be funny because you can start seeing it, man. Like even you now, like if you start talking to fellow traders, you can kind of see some of the outline of issues. Not saying you're a better trader than them or anything like that, but you can start sensing and picking up on fear, greed, just different elements. Not judging anybody, but usually when they come to the table with certain issues, like why can I get you see a lot of people searching for a perfect entry, and you can break that down to most of the time it's mindset.
Is
Yeah, my internet just glitched out, man. But yeah, I was just wrapping it up, man. Anything anybody else want to tap into, man? Any comments, questions, concerns?